Good morning, everyone. This is Kevin Robbins, CEO of Mid-Atlantic Employers Association. I am glad to see so many people joining us on such short notice. As we all know, over the weekend, there was a mad rush towards a stimulus package, which passed Congress, I think late Sunday night. We probably all assumed it would be law at this point. It's not, with some last minute White House negotiations going on, but nevertheless, I think we're going to expect most of the provisions in there to be stay in place regardless of what happens. So what we wanted to do today is bring our two experts, Mario Vicari from Croce and Mike Trackman from Wisprol on. They've been speaking about the stimulus and the PPP throughout. They do a great job, both kind of what it says as well as what could be wrong, and a lot of things have been changed. I just want to say that, this is before, we wanted to get this in before the holiday to make it a directional, not dispositive conversation. The bill itself is 6,000 pages. There's going to be guidance coming out, but there are a number of provisions that apply to everybody. There's a number of provisions that apply to businesses that have really been impacted and, a second shot of support, as well as some businesses that weren't eligible before that now are. So again, we wanted to give everyone a quick pre-holiday sense of where to kind of be looking going forward. It's going to be a very informal way of approach because, again, we're doing this kind of very quickly given the holiday coming up. So we're going to have Mario is going to speak to Ppp Loan aspects of the package, and then Mike will start later with kind of everything else. If you do have questions, please put them in Q&A or chat. Just recognize we don't have the answers right now. This is, but we're just giving you a good sense of what's in here and how it relates. I think I saw an email earlier from someone, everyone's kind of interpreting, and the point of this is to give everyone a kind of a gut check to say, okay, this is what it seems like it's saying. So again, thank you for joining us. I really want to thank Mario and Mike for doing this. They got an email from me on Sunday saying, hey, can we get something together by Wednesday? And they did it. So with that, I'm going to open it up to Mario to join us first.
Thanks, Kevin. And good morning, everyone. It's good to be with you again. As Kevin said, I'm going to cover broadly the PPP parts of this. And I'll be looking down at my notes here because, as Kevin said, this is a pretty long document. So I have some notes sketched out on paper here just to keep track of my thoughts. But the first thing I thought I'd start with is sort of a rollback to the last time we were together when we talked about this loan necessity questionnaire. There's been something that has transpired since then. I'll just cover it quickly because it's important to those of you that have loans greater than $2 million. That form was out for public comment through the 25th of November. They got a ton of public comments, and the same day on the 25th, they started issuing the form. So that form is in use. It's not going to change. However, what we got in response to it was another frequently asked question, which is actually quite good for borrowers. So you want to go to the SBA website and read through it, but I'll give you very quickly the highlights. There were a lot of complaints about that form in terms of looking back at history or actual results after the fact and taking things into account that were not part of the original CARES Act. But there's some important language in there that's pretty good for the borrower. Number one, it says that the certification is required to look at time of the loan application, even if subsequent developments resulted in the loan no longer being necessary. So that, I think, is a big win for borrowers. Secondly, the SBA must take into account the borrower's circumstances and actions, both before and after. Thirdly, in response to that form where they require give you only 1,000 characters to write your case, it's pretty clear here that it says that the SBA can request more information and the borrower can submit a narrative. So now, again, I think that's a response to people complaining about not having enough room to write their case down. And they're going to use a multi-factor analysis, whatever that means. So the point here, just quickly out of the gate, is we're not getting a new form. That form is being used right now. I have clients who have submitted it already, but this FAQ is a net win for the borrower. So now to talk about the latest bill that Mike and I have been studying, and all of our colleagues. The first, and I think one of the most important things, is we've gotten final clarity on the tax treatment of the PPP loan. To quote, no amount shall be included in gross income by reason of loan forgiveness. That was in the original CARES Act. Here's the new language. No deduction shall be denied, no tax attribute shall be reduced, and no basis increase shall be denied by reason of exclusion of loan forgiveness from gross income. So this corrects the IRS's position about the fact that, the PPP expenses were not going to be tax deductible. And I'm not going to go into a long discussion of why the IRS had to do that. It has to do with longstanding case law. But basically, this says that no deductions will be denied because of loan forgiveness. So the net effect of the IRS's position is the loan forgiveness became taxable for everyone and creates phantom income. Well, now that's when this bill gets signed, that's pretty clear. Along the way, there were questions of whether there were going to be, guide rails on that, whether there were going to be limitations. It is unlimited, and it's very clear that that the costs are going to be deductible and the income is not taxable. So I'm going to talk next about some broad changes to the PPP program in general that came through this bill, because they've changed. They've added definitions of additional borrowers to this that were not in the original CARES Act. So the original CARES Act and the borrowers that were able to participate, veterans organizations, tribal organizations, all businesses, all that's still in play, but they've added some specific new designations of entities that can participate here. The first one is 501c6 organizations. So those are a form of a not-for-profit that were not specifically in the original CARES Act. Destination marketing organizations, housing cooperatives, newspapers, broadcasters, and radio stations. So they have added specific categories of businesses that are specifically allowed to participate that may not have been allowed before. There's also a specific prohibition now on publicly traded companies accessing this program, which was a big element of debate back in the April-May timeframe, when disclosures were made about publicly traded companies who had access to credit markets and so forth getting these loans. So those are out. Another change related to the existing program is the last update that we got over the summer. The covered period that you chose could be either 8 or 24 weeks, or really anywhere in between. That's still in existence. They reiterated that guidance, that covered period, meaning the time that you have to spend the money, could be at least 8 and as much as 24, but you could pick your time. But the covered period had to end by December 31st. You couldn't go past that. They've extended that to March 31st. I think that's because if you recall, there was they added more funding to the first round of PPP. I want to say in the May or June timeframe, and more companies borrowed in the latter part of the summer before it ended in August. So some of those companies could need longer time to spend their money within the allowable timeframe, then they may not get it done by December 31st. So it's now March 31st, and that applies to the PPP in general. Other changes. They've added new categories of allowable expenses. First is called covered operations expenses. Now remember that these are in addition to the allowable expenses from the original CARES Act, which included, utilities, interest on mortgage, payroll costs, all those other things are still included. We're not going to go back through those. These are just additive now for things that a borrower can spend the money on to use the money. So the first is covered operations expenses, which include business software or cloud computing expenses related to payroll, HR, sales, billing, and accounting. So things related to your internal systems that are software related, that sort of run your the business internally, those can be included. The second is covered property damage costs. So to the extent that you're a business that has had property damage because of the civil unrest in the country, during the summer, rioting and so forth, if you had a business storefront or something that was damaged, those those costs would be now allowable under the, to be used under this program. Third addition is something called covered supplier costs, which is very broad. I'll read the definition. Supplier of goods essential to the operation of the entity. To me, that means any supplier that you're buying, sort of materials for, that are important to the operation of the business would be included. I mean, that's kind of a big catch-all category. Again, as Kevin said earlier, this is the law. What happens is when the law gets passed, the regulations go to the administrative agency, which in this case is going to be the SBA, and then they're going to write regulations about what these definitions really mean. So, but that covered supplier cost is a huge, broad item the way it's written in here. And then lastly, covered worker protection expenditures. So this would be personal protective equipment, changes to your facilities. If like I have one client that changed their bathroom configuration to be touchless, those kinds of things, heat sensitive things to, use the utilities, putting barriers up, any of those physical changes to your facility, putting different filters in your HVAC, any of the safety stuff that you did for the benefit employees are now allowable. So we have more places to spend the money than the original categories. A clarification that they made also was, if you recall, payroll costs in the original CARES Act included payroll, health insurance, retirement expenses. Within the health insurance category, they made a specific clarity here to include group life insurance, disability insurance, vision, and dental coverage. So we've been always advising people that that's part of your group benefits. But I think it specifically said health insurance related things. So this clarifies and says, look, these other things that the employer pays for are part of the payroll costs now. So those.
Mario, one quick question, just to clarify, is there still a requirement that at least 60% be used for people costs?
Yeah, as far as I know.
Okay.
I don't believe that that's changed. Okay, so those things that I just went over are kind of like retroactive changes, the way I read it, to the program the way it exists. Now, if you're a first-time borrower, I'm going to talk now about what's called the second draw PPP loans, the way it's described in this bill. There's actually a little bit of debate about this. I'm not 100% sure about what I'm going to cover here in terms of a first-time borrower, but I believe that a first-time borrower does not have to meet requirements for reductions in revenues and things like that in order to be able to participate in PPP. But I want you just to make a note there, because I'm actually having a debate about that with some of my colleagues. But there has been a lot of people who've come down on writing, and other people who study this stuff, that say, yeah, it looks like new borrowers won't have to, if you're borrowing for the first time, you won't have to meet other requirements like reduction in revenues and so forth, like I'm going to cover in a minute. So it looks like that's the way it's intended, but you want to stay tuned for that, just to clarify that if you're a first-time borrower. Okay, so we're going to talk about what they refer to in this bill as second draw PPP loans. And one of the important things here is that the SBA has 10 days from the date that this is signed to provide guidance on the way that this is going to work mechanically. Now, good luck with that one in what that's going to look like. But basically, these are the new requirements to apply for a PPP loan. Definitely if you're a second timer in terms of the fact that you've gotten a first loan. So the way the rules are written now is it's businesses with 300 or fewer employees, and you have to demonstrate no less than a 25% reduction in your gross receipts, by the way, is what's in here. Reduction in gross receipts in any quarter of 2020 compared to 2019. There's actually a lot more to this in the bill that, if you weren't open in 2019, and ways to calculate all that math. It's many pages, but the gist is that if you have fewer than 300 employees, and you can demonstrate that in any of the quarters in 2020, that your revenues in 2020 compared to the same quarter of 2019 have dropped by at least 25%, you should qualify for another PPP loan. So those are the new requirements. Again, I don't believe that first-time borrowers have to meet these requirements. If you're coming back for a second round, I believe that you definitely have to meet these requirements for the second round. Now, the way that the maximum loan is calculated is it's similar to the way it was done the first time, 2.5 times your average monthly payroll cost. So many of you probably remember way back in April when we were talking to many of you about how to get your application in. It was basically 2.5 months of your payroll costs, which include, your payroll, your health insurance, all that stuff, and then multiply by 2.5 to determine the loan amount. Remember that there was an initial cap on the size of the loan. I think originally it was a max of 10 million. Now the max loan is 2 million. So it's 2.5 times your average payroll costs. You're going to be doing a similar application, but the maximum loan is 2 million. And the way that you calculate the payroll costs under this bill is you can do you have a choice. You can go back to 2019 and use that data for the basis of your application, or you can do a look back from the time you make the application of 12 months look back from the date that you apply. So many of you that have had payroll reductions and things like that, you obviously would want to use 2019 if you were fully staffed for that year. You're likely to get a better answer. NAICS code 72 businesses, which include food service, accommodations, those kind of businesses, hotel industry, those kind of leisure type activities, you get 3.5 times your payroll costs. So they're providing a bigger benefit to categories of borrowers that are the most hardest hit. If you're a prior borrower under PPP and you want to go for round 2, you must have used all your funds. You can't have not spent the money or not sort of use the money you originally had and come back for more. You got to demonstrate that you used the original funds as intended. It doesn't really comment about whether you need to be forgiven yet or not. It just talks about you have to have used those funds. So on this second draw program, there's going to be regulations issued, and I'm sure a new application form and all that other stuff. I think that's what you're talking about when they say the SBA has 10 days. So after this is signed, within 10 days, they're going to issue regulations about the way this works. And I'm sure, again, an application form. And just like before, they're going to need to issue guidance about when applications will begin being accepted. All that stuff still has to be forthcoming in the regulations that SBA issues. The last item that I want to talk about is forgiveness. There is language in here about forgiveness. There's a side loan forgiveness form going to be created. The SBA has 24 days to get this form out. If you have a loan of $150,000 or less, it's going to be a one-page simple certification forgiveness form that you send in. If you have more than a $150,000 loan, they don't talk a lot about it other than it has language in it that the SBA must create an audit plan within 45 days as to how it's going to review those loans. So if it's a loan above 150, the SBA is going to come out with more language about the way it's going to review, those loans. Not necessarily the forgiveness calculations and all that. I believe that that's all going to be the same. It's going to be a similar process to submit for forgiveness. I think that they have to issue guidance, or they're being told to issue guidance about the loan review process, which right now we're dealing with this, this 3509 form for the larger loans. But loans below 2 million, there is no, loan review. Here, they're saying they're going to come out with guidance about how they're going to review these loans for good faith certification. At that point, that's what I wanted to cover, and I'm going to turn it over to Mike.
Before we do that, Mary, there are a couple questions here. Let me just run through these real quick. Someone asked, their financial institutions saying they should submit for forgiveness before year end. Do you see a reason you're saying that if you're qualifying for second, they're not saying you have to submit it to the loan forgiveness. Is there a reason to do it now?
No, I don't think it matters a whole lot. There were some people who were concerned about submitting now or waiting because of the taxation of this. I still don't even know that matters. The only thing I would say is if somehow the forgiveness is limited or some reason, you can include more costs now these things, these new includable costs, could allow you to add more cost to your application. But I still think that most borrowers that I've worked with really haven't gotten into all these other kinds of costs because the covered period can go longer and they
Right.
include their payroll. So at this point, I personally have been telling people there really isn't anything more that we need to know in order to be unsure about how to file for forgiveness. So my answer would be, I would go ahead and do it.
Can I just ask a question about that? My impression, and it's only an impression because I haven't dived into the PPP aspect to the extent you have yet, but to the extent there are these additional categories of expenses that may be included and on which you may spend your forgiveness amounts, my understanding was that would only apply on the first round if you haven't already submitted an application for forgiveness. But if you've already submitted your application for forgiveness, you're locked in.
That's right.
But one incentive, therefore, to delay the application for forgiveness is if you're having trouble spending the money in the right way, then you might delay your application for forgiveness to loop in all of these other categories that have now been opened up if you're a first-time borrower.
Correct, Mike. I
Okay.
agree.
Okay.
Another question, if somebody's utilized PPP EIDL and Main Street loans, could they seek a second PPP? And I think it goes back to that 25% loss in revenue question. Does it matter that you take another loan at this point?
Well, the answer, the way I read it is, it shouldn't preclude you from applying for PPP again. There is a change in the way the EIDL loan is going to get applied, but I'm going to leave that. Mike has that in his comments to talk about. There's actually a fairly substantial change in the EIDL program as it relates to PPP. But the answer is no. If you've used all the PPP funds, as far as I read this, and as long as you meet these new requirements, you should be able to apply for PPP too.
And we had a question about the emergency-paid sick leave, Mike, which I know you're going to cover that, so we'll hold off on that. You brought up gross receipts as the measurement for the loss. Someone's asking, is it cash or accrual basis for that?
Yeah, so here's where we'll get details in the guidance. I mean, I mentioned gross receipts because that's actually what's written in the law. I've already gotten a bunch of questions about that. Well, is it my net revenues? Is it my, is it cash basis? Do I use my tax return? The answer is, I don't know today. I believe that they will issue a definition of what gross receipts means when they issue this guidance in 10 days from the time that this thing is becomes law. They're gonna have to issue guidance that says, here's what gross receipts mean. Here's how to calculate it. And, I expect if they did it correctly, there would be, for most companies, I think it's going to be out of your, accrual basis financial statements, unless you're a cash basis taxpayer or something. But ended upon, because lots of different businesses calculate, is it gross? Because this says gross receipts. I don't think that they mean gross revenues if you have, like reductions for, chargebacks or, whatever reduces your revenues to net or discounts. I think they just mean revenues. And much of what's been written has referred to revenues. So there'll be definitions coming.
And somebody asked a question, which I thought I knew the answer, but maybe I don't. The first loan was for companies up to 500 employees. I know we're saying if you're going for a second request, it's 300 or less. If this is your first request, is it still back to the 500?
That's part of that question that I raised earlier. I believe so, but I'm not 100% sure. We're having like a running debate about what applies to whom. So
all right, so that's one that we'll have to keep an eye on. And again, I just also want to say we're giving, like I said, that really quick interpretations today. Once we get more guidance, first week in January or so, we're going to get Mike and Mario back on a town hall to give more specificity. So these are all great questions. Someone asked too about any changes in the FTE calculations. I think all this would be coming out in more interpretations, those very specific kind of questions. So with that, why don't we turn it over to Mike to cover everything else that's in the stimulus.
Thanks, Kevin. I appreciate the opportunity. I want to make actually 6 points or cover 6 things. I'm looking at my notes as Mario did it well because we're all on last minute here with no slides, etc. I think the first point that's really important to understand here is that this deal was done with the understanding that it wasn't done. It was done with the understanding that the parties would reconvene after the Biden administration took hold. And the only way, and we're starting to get leaks now as to how the compromise was actually made. What happened was that leaders of both parties got together actually in Lisa Murkowski's living room, I'm told, or I've read, with the windows open and socially distanced and masks on. And the Republicans agreed to drop a key demand of theirs, which was a business liability shield, and the Democrats agreed to drop a key demand of theirs, which was additional funding to the states. And they agreed to basically craft something that would get the country into March, with the understanding that they would then reconvene in early 2021. And depending on where the leverage sat at that time, the deal would be done one way or the other. And by that, I mean, more than anything else, depending upon how the Senate runoff elections in Georgia went, which would define an awful lot of the leverage. So just understand that this is meant to be and understood to be by all parties something that is geared towards spring in many respects, with more to come. And the key is to stay informed, and we'll try to do that, and to stay very nimble. I'm obviously getting a lot of questions with respect to what's going on right now. Is the deal going to get done? Trump's threatening not to sign it, et cetera. The best commentators that I read, and I'm obsessive about this now, it's become better than any show on Netflix for me, is that now that the Republican leadership has declared that on January 6th, they will approve the results of the Electoral College, notwithstanding Trump's demand that they not do so, Trump has gone into attack mode on the Republican leadership. What he's done now puts him in a very awkward position. That's the goal. So I don't think there's any realistic chance that it doesn't pass. The votes to override any veto are there. Trump doesn't want to be embarrassed by a veto vote. Question is whether or not there's going to be delays that are going to be inordinate, but it'll pass. The second point is very important and is not being stressed as much as I think it needs to be in a lot of the media. And that is that all of the webinar work we did and the writing that the MEA personnel did in respect to the FFCRA and the mandatory paid sick leave and the mandatory paid FMLA for COVID-related illnesses, that was written into the CARES Act to die as of 12/31/20, and everybody pretty much assumed that that would be continued into 2021, that the obligation to pay those paid leave payments to employees who are quarantined at home and parents who have to stay home to deal with kids, that sort of thing. The assumption was it would be continued, and it was not. So the obligation to make those mandatory paid leave payments will expire, even if employees have previously applied and have 80 hours, they haven't expended their full 80 hours of entitlement or all of their FMLA, it stops. The obligation to pay it stops on December 31, 2020. The law says that to the extent employers voluntarily choose to make those payments thereafter, you still get the tax credits that were built into the law before for having made those payments, but you don't have to make those payments. This raises a whole host of issues that I'm sure we'll deal with on another occasion. Even if the payments are not required, even if the mandatory leave's not required, the ADA rises up here and imposes a bunch of really sensitive issues that you need to be keyed into. The FMLA rises up. I can see discrimination claims coming down the pike here in respect to who do employers voluntarily make these payments to, and how do they select the ones they do not make these payments to. Documentation will be of extreme importance with respect to all of this. But the key message right now is that the obligation to make these paid leave payments under federal law no longer exists. Depending upon the states and the localities where you do business, there may be obligations there at that state and locality level, but the FFCRA mandatory payments no longer exist as of 12/31. Number three, a related tax issue has to do with the employee retention tax credit. As most of you know, the prior legislation enacted a tax credit provision for retaining employees in certain circumstances. That's still there. It's been expanded fairly substantially. Actually, it used to be, I think, 50% of wages. Now I think it's a 70% of wages. There used to be a $10,000 payment limit Now it's $10,000 per quarter. So keep an eye on that. The employee retention tax credit is there and expanded and amplified as an incentive for businesses to continue to retain their employees. Number 4 has to do with unemployment compensation issues for those companies that do have employees that are not working and are entitled to unemployment. You will recall that in the previous legislation, the federal government was paying $600 a week extra added on to unemployment compensation. This raised a whole lot of issues and objections in respect to employees who would do better by staying home and staying on unemployment than by coming back to work. The new law extends it, but only until March 14, although you can play out your entitlements into early April, I think, thereafter if an employee fits and has entitlements left. But again, this is something to get through the spring and will be a subject of conversation thereafter. But the federal add-on is halved. It's now $300 and not $600. Again, it runs out, I think, on March 14, and there are a litany of amplified requirements that are meant to attack employees who refuse to return to work when work is available. Mandatory reporting to unemployment authorities by employers who are dealing with employees who refuse to come back to work, to address a lot of the objections that were made by companies previously about the $600 add-on and employees that were just staying home even though there was an opportunity to come back to work. That's been addressed in this new legislation. The 5th point that I think is worth noting has to do with evictions. This is important for those of you who are trying to manage your employees and those of them who are suffering with eviction possibilities, and also those of you who may be in the residential real estate business. The new law has put a moratorium on the eviction of tenants until January 31. So just extended it that brief time. Again, you can bet that's going to be a primary focus of negotiations between the Biden administration and Congress, top of mind right after the inauguration, because that eviction moratorium only lasts until January 31 for rental tenants. HUD introduced its own regulation, which extended mortgage foreclosures until February 28. There is also expanded rental relief to tenants, that money that will help people pay their rent. That's built into this as well. But this will be a major topic, I know, for the Biden administration. And then finally, the 6th point that I think is worth stressing here, and I'm focusing on what I think is a primary interest to MEA members. There's obviously a tremendous amount, not only of other detail in respect to what I talked about, but other topics as well, ranging from climate change to all manner of topics, including surprise medical bills, all sorts of things, which aren't directly on point for the purposes of today, but there's a whole lot else in this bill. But I think the EIDL loans, the emergency loan program that has been in effect for many years as administered by the SBA is worth commenting on. This is a loan that bears interest at 3.75%, and it's very targeted and tightly administered by the SBA, so that it can only be used for certain expenses. You can't duplicate what you spend the EIDL loan on and what you spend a PPP loan on, although you can get both. There's a separation in terms of how you spend the money. You have to track it. The SBA audits this stuff, so it's important to deal with. A couple of points here under this new Stimulus Act. There's an expanded EIDL program. More money has been devoted to it, but it's targeted to companies that do business in low-income areas, and it's targeted to companies that can document a 30% loss of revenue as well. So there are some limitations with respect to this. The other part of it that I think Mario was alluding to as well is that part of the EIDL loan program is that right off the bat, companies who would seemingly qualify for an EIDL loan were entitled to a $10,000 grant. Just a check right off. In a couple of days, people would get these grants, but those grants were taxable income, and they were also they affected your PPP forgiveness as well. As I understand it, that's no longer the case. Those $10,000 grants are no longer taxable, and they won't affect your PPP forgiveness either, which makes it a bit attractive. But the EIDL loans are severe, and it's worth getting some significant advice as to whether you go down that road. You need to be very troubled. You need to be in a low-income area. There are other SBA programs as well, but this one was specifically targeted, and it's worth mentioning. So the watchword to me throughout all this is to be informed, because stuff is going to change, and it's going to change quickly, not only in terms of the guidelines and the regulations that will be coming out. 10 days is a pretty tall order for the SBA. I've got my doubts as to that, but there's certainly going to be guidance that's going to come out and regulations that's going to come out. But on top of that, I think there's going to be a spate of new regulations from various federal departments in late January and February, after the Biden administration takes hold. There's going to be executive orders that are going to affect all of this in various ways as well, which is a whole other topic. So between the regulations from the departments and the executive orders, and then there is going to be a push for new legislation on top of this stimulus act, because, as I said, both sides recognize that that was the understanding. They will reconvene, watch that Georgia election, that will tell the tale. So be informed, be nimble, that will be very important, and obviously stay well.
Hey, Mike,
Thanks, Mike.
could I ask
Go
a
ahead.
question about the EIDL, or a clarification in terms of the way you see it? So originally you weren't, if you did an EIDL loan, and you got a PPP loan, when they funded your PPP loan, you couldn't have both. They took your EIDL loan off. They netted it. Is it your understanding with the new rules that they repeal that now? And can a borrower go back if an existing borrower, at least my understanding is, if you were an existing borrower of an EIDL, and let's just say you had a $200,000 EIDL loan, and then you got $1 million PPP loan. When you got your PPP loan funded, they paid your EIDL loan off because you couldn't have both. The way I read it is you can go back if you had it netted before, because they repealed that you now can have both. You can go back and get that money back. Is that the way you read it?
I don't know. I don't know. That's not clear to me. And further, what's not clear to me is how the specific new program coexists with the second round of PPP loans, where you're directing the EIDLs into low income areas with a mandatory 30% loss. I'm not sure how all of that works yet. I would hesitate to speculate. I just don't know.
So what I would just add then on that point is, for those of you that had both loans, that you had an EIDL refunded, like when they said you couldn't have both and you had it netted, you want to make sure you talk to your bank, because I need to reread it because it's a little bit complicated. And again, we're seeing it for the first time, but I think that there's a chance or an opportunity to go back, because the way I read the repeal language is it goes backwards to repeal the way it was originally done, at least the way I read it. It may allow you as a borrower to go back to your bank and say, hey, I want the rest of my PPP loan that I didn't get because you netted my EIDL loan against it. So
yeah,
I'll go back to your bank.
I'll bet that, as was the case in the early days of PPP, some banks will treat it one way and other banks will treat it other ways, until it gets straightened out. Like, different banks were treating independent contractors early on and the like. There were such inconsistent processes. I think we're going to be in for another round of that.
And while we're talking about banks, so I think the one thing you can be doing now is, if you have not received the PPP first round, you definitely want to begin to reach out to a financial institution to get lined up. That was one of the big flurry issues before. And if you are someone that did receive the first round, but you believe you'll be eligible for the second round, same thing, reestablish or make sure you have that relationship in place. I know a number of the banks are reaching out proactively, but you just want to make sure you know what their process is going to be, because that's an important part of this, is getting that bank process down.
A lot of banks.
Go ahead.
I was just going to say, a lot of banks got a lot of bad publicity and a lot of bad PR and a lot of pushback because they were favoring larger customers over smaller customers, and they weren't taking care of people based upon their position in line. They were dealing with their self-interest. My sense is there's going to be less of that this time around, that the banks are going to be more sensitive to priorities that don't necessarily relate purely to the bank's business interests.
Well, especially because you're going to have much smaller amounts and smaller size companies.
And they already have their portal set up last time they had a
Right.
week
Yeah.
portal
Right.
set up, and it was a mad dash for everybody. At least now everything it should be a much more regular, is the word I'll use, a regular type process of communicating with them, because they'll be prepared.
Yep. So we did have a couple quick questions for you, Mike. For the FFRCA going to voluntary, can the company create their own documentation policies, bearing in mind HIPAA and any other requirements, or are there
Yeah.
specific guidelines? Okay.
No, there is no specific guidance. You can pay that and voluntarily, if you want, within the criteria of the FFCRA. I'm not saying that, and I don't believe the law is that you will get tax credits for making voluntary payments to employees that do not fit within the criteria as previously established by the FFCRA, which was rather detailed criteria as to who got paid leave and who didn't and in what percentage. So if you stick within those pre-existing criteria within the FFCRA, as I read the law right now, you will be entitled to the tax credit. If you pay voluntarily leave outside of that criteria, no, there's no indication that you're going to get a tax credit for that.
Yep. And for MEA members on this call, once we get through, the holiday, you can call the hotline in legal and we can help you with those guidelines, because we did that extensively in the first round. Someone asked about the status of the Main Street loan program. I'm not familiar with that at all.
I'm not there.
Yeah, I'll take a shot. I did read a section that was part of the Treasury allocation that they've been arguing about, where Mnuchin said it expires, give the money back. It was part of that allocation. And as far as I know, it ended and it's not been renewed. If they're going to do it again, I think they'd have to reestablish, the funding for it again. That's my read of what I looked at in the last few days. So I don't think it's presently available.
Okay.
One other thing that I think is worth mentioning that the commentators that I've read think there's some confusion on is how things are going to play out for reductions in FTEs on this second round, and in particular with loans under $150,000. There's some commentators that I read think that there were some things left out of the statute that will be put back in and the like, but there's some lack of clarity right now in regards to reductions in FTEs and how that might affect forgiveness amounts, at least as I read it.
One final question here. Can an organization get the employee retention tax credit retroactively if they've already received PPP? And do you have any sense of what the requirements would be going forward? So was it the rule that if you had a PPP, you couldn't take the retention credits, or? I don't recall that.
I think you could do both, but I think you had to exclude the payroll from your eligible cost.
You can double dip.
Oh yeah.
But remember that the rules for the employee retention tax credit now are more, they're amplified. They're different. You get more of a tax credit in more liberal circumstances now, starting on the effective date of the act, up to a particular end date, which I think is pretty far off in the future.
So for someone that's not going to receive the second PPP loan, this is another benefit that would apply going forward. Gotcha.
Yes.
All right. I think we might have one more question came in. If payroll services cease documented 12/31, people out of FFCRA without credits will until year end for the employees. I'm not sure I know what that means. John, if you want, we can try to. We can talk about that later. Mike, I'm not sure if I know what that means.
I'm not looking at the question, so.
Yeah. All right. Like I said, John, you can email me and I can do a dialogue afterwards, krobbins@mea.info, and I can help you get an answer on that one. Once again, Mike and Mario, I tremendously appreciate you jumping on this call so quickly. I know we had about 200 people, and I think they appreciate kind of getting this very early guidance. When we'll send out the recording, if you all like to share it. We'll also have the invites for January town hall sessions, and if you want to enroll for those, we'll probably kind of have version 2 of this in one of our Tuesday town halls. So put yourself on the registration so you'll be able to be informed about that. Thank you all very much. I hope you all have a happy holiday season and a safe one as well. Take care.
Well,
Thank you, everybody.
bye-bye, thanks.